Chapter 7, Internal Control. In 2013, the Committee of Sponsoring Organizations issued an update to the 1993 Integrated Framework, which defines internal control as a process effected by the entity's board of directors, management, and other personnel designed to provide reasonable assurance regarding achievement of objectives relating to operations, reporting, and compliance. By including the concept of reasonable assurance, the definition recognizes that internal control cannot realistically provide absolute assurance that an organization's objectives will be achieved. Reasonable assurance recognizes that the cost of an organization's internal control should not exceed the benefits expected to be obtained. In the three areas of internal control, reporting, operations, and compliance, COSO states that a series of control objectives and sub-objectives exist. To illustrate this concept, consider internal control over financial reporting. At the top level, the overall objective is to prepare and issue reliable financial information. At the very detailed level, as applied to the AR sub-objectives, there may be several sub-objectives such as all goods shipped or accurately billed in the proper period. These control objectives are similar to the management assertions that were discussed in the preceding chapters. This is obviously the case because the overall objective of internal control over external financial reporting is to prepare financial statements in accordance with generally accepted accounting principles. There is a difference, though, because internal control objectives are broader in that they relate not only to financial reporting but also to operations and compliance. The importance of establishing and maintaining effective internal control is also illustrated by the passage of the Foreign Corrupt Practices Act. This act was passed in response to American corporations' practice of paying bribes and kickbacks to officials in foreign countries to obtain business. The act requires all corporations subject to the jurisdiction of the SEC to maintain an effective system of internal controls. Violations of the Foreign Corrupt Practices Act can result in fines up to $1 million and imprisonment of the members of management who are responsible. Thus, an effective system of internal controls is required by federal law for many corporations. Internal control of an organization may be viewed as including 5 components: the control environment, the risk assessment process, control activities, the information system relevant to financial reporting and communication, also called the accounting information system, and monitoring activities. The control environment may be viewed as the foundation for the other internal control components. It is defined by the standards, processes, and structures that guide individuals in carrying out their duties. The basic principles of the control environment include commitment to integrity and ethical values, a board of directors who demonstrate independence from management and exercise oversight of internal control, establishment of effective structure, including reporting lines and appropriate authority and responsibilities, commitment to attract, develop, and retain competent employees, and holding employees accountable for internal control responsibilities. Organizations ordinarily face a variety of risks from external and internal sources that threaten their ability to meet their objectives in the area of operations, reporting, and compliance. Risk assessment is management's process for identifying, analyzing, and responding to such risk. In performing effective risk assessment, organizations should clearly specify objectives to allow the identification and assessment of risks related to those objectives, identify and analyze risks to the achievement of its objectives to determine how they may be managed, consider potential fraud relating to the achievement of objectives, and identify and assess changes that could impact internal control. Control activities are policies and procedures that help to mitigate the risk that the organization's objectives are not met. Performance reviews include comparisons of actual performance to budgets, forecast, and prior period performance. Transaction control activities are performed to check the accuracy, completeness, validity, and authorization of transactions. The major types of control activities include authorizations and approvals, verifications, physical controls, controls over standing data, reconciliations, and supervisory controls. Physical controls include those controls that provide physical security over both records and other assets. Activities that safeguard records may include maintaining control at all times over unissued documents. A fundamental concept of internal control is that no one department or person should handle all aspects of a transaction from beginning to end. Incompatible duties include authorizing transactions, recording transactions, and maintaining custody over assets. This diagram establishes proper accountability for assets, segregation of custody and record keeping, as well as reconciliation of the assets held by A to the records maintained by B at reasonable intervals. The goal is not to allow an individual to have incompatible duties that would allow him or her to both perpetrate and conceal errors or fraud in the normal course of his or her duties. An organization's accounting information system consists of the methods and records established to record, process, summarize, and report the entity's transactions and to maintain accountability for the related assets, liabilities, and equity. Accordingly, accounting information systems should first identify and record all valid transactions, 2. Describe on a timely basis the transactions in sufficient detail to permit proper classification of transactions for financial reporting. 3. Measure the value of transactions in a manner that permits recording their proper monetary value in the financial statements. 4. Determine the time period in which transactions occurred to permit recording of transactions in the proper accounting period. And 5. To present properly the transactions and related disclosures in the financial statements. Monitoring of controls, the last component of internal control, is a process to assess the quality of internal control performance over time. Ongoing monitoring and evaluations include regularly performed supervisory and management activities such as continuous monitoring of customer complaints or reviewing the reasonableness of management reports. Separate evaluations are monitoring activities that are performed on a non-routine basis, such as periodic audits by the internal auditors. Financial statements include a number of significant accounting estimates, including estimates of fair values of assets and liabilities. Controls over these estimates are particularly important because the development of them often requires significant judgment. Controls that should be established for accounting estimates include the control environment and procedures that encourage proper estimates as well as risk assessment and appropriate responses to these risks. Policies should be established to ensure that qualified personnel are involved and that relevant, sufficient, and reliable data are considered when developing any estimate, and that models used are consistent with the financial reporting framework. Management should review the sources of data and processes used to develop the assumptions and changes in the methods used and reasonableness of assumptions. When necessary, specialists should be included in making estimates, and policies to improve estimates should be in place. Internal control can do much to protect against both errors and fraud and to ensure that organizations' objectives are achieved. Still, it is important to recognize the existence of inherent limitations of internal control. Mistakes may be made in the performance of controls as a result of misunderstanding of instructions, mistakes of judgment, carelessness, distraction, or fatigue. Control activities, whether manual or automated, that are dependent upon separation of duties may be circumvented by collusion among two or more people. In addition, management may inappropriately override internal controls and enter into side agreements with customers that may alter the terms and conditions of the company's standard contract in a way that would preclude revenue recognition or improperly modify the accounting records. Also, compliance with controls may degrade or deteriorate over time. Internal control varies significantly from one organization to the next, depending on such factors as organization size, nature of operations, and objectives. Yet certain features are essential to satisfactory internal control in almost any organization. Preventive controls are aimed at avoiding the occurrence of misstatements in the financial statements and include controls such as segregation of duties. Detective controls are designed to discover misstatements after they have occurred, such as monthly banking reconciliations. When detective controls discover a misstatement, a corrective control is ordinarily needed to remedy the situation. Maintaining backups of key transactions to allow for the correction of data entry errors is an example of a corrective control. Some controls are complementary, meaning they function together to achieve the same control objective. Others may be redundant if they address the same financial statement assertion or control objective. If a control reduces the risk that an existing or potential control weakness will result in a misstatement, the control is called a compensating control. Small business owners may provide a compensating control by reviewing the accounting records frequently if they are unable to achieve proper segregation of duties because of a small staff. Many organizations have established an enterprise risk management system. Enterprise risk management extends beyond internal controls to focus on how the organization can maximize value for stakeholders by effectively managing all risk and opportunities. COSO issued a new internal control framework in 2004 on enterprise risk management. It does not replace the original COSO internal control framework, but it goes beyond internal control to focus on how to manage risk and opportunities. The auditing standards are still structured around the original COSO internal control framework. It is not necessary for an organization to implement an enterprise risk management system, but those who have one should do a much better job of managing business risk. In this slide, we have the 6 steps included in the overall approach of an audit. Steps 2 through 4 of the overall approach most directly relate to the role of internal control in financial statement audits. The auditors must first obtain an understanding of the client and its environment, and in this case, especially the internal controls, and then the auditor uses their understanding and other evidence to assess the risk of material misstatement. Results of the risk assessment are used to design the nature, timing, and extent of further audit procedures. The design of further procedures includes the proper combination of testive controls and substantive procedures. In making a judgment about the extent of the understanding of internal control that is necessary, the auditor should realize that the information will subsequently be used to identify types of potential misstatements, consider factors that affect the risk of material misstatement, and design testive controls when applicable and substantive procedures. In all audits, the auditor's understanding of internal control should encompass each of the internal control components. In obtaining an understanding of the client's internal controls, auditors may find that there are certain areas that are particularly difficult for management to control. These include non-routine transactions that are unusual due to either size or nature and occur relatively infrequently. Auditors should identify areas of risk of misstatement that require special audit consideration due to complexity of calculation, risk of fraud, selection and application of accounting policies, internal and external circumstances giving rise to business risks such as technological changes and recent development in the industry and economy. How do auditors obtain an understanding of a client's internal control? Procedures include inquiring of entity personnel, observing the application of specific controls, inspecting documents and reports, and tracing transactions through the information system relevant to financial reporting. While obtaining an understanding of internal control, the auditor may also obtain evidence about the operating effectiveness of various controls. The distinction between knowing that a control has been implemented and obtaining evidence on its operating effectiveness is important. The evidence on operating effectiveness is obtained by performing tests of controls, which are discussed later in this chapter. An external auditor obtains a working knowledge of internal controls. They should document the information in their working papers. The form and extent of this documentation is affected by the size and complexity of the client, as well as the nature of the client's internal control. The documentation usually takes the form of internal control questionnaires, written narratives, or flowcharts. The traditional method of describing internal control is to fill in a standardized internal control questionnaire. Many public accounting firms have developed their own questionnaires for this purpose. Written narratives of internal control are memoranda that describe the flow of transaction cycles, identifying the employees performing various tasks, documents prepared, records maintained, and the division of duties. A system flowchart is a diagram or symbolic representation of a system or a series of procedures, with each procedure shown in sequence. After describing internal control in their working papers, the auditors often will verify that it has been implemented by performing a walkthrough of each transaction cycle. This is a cash receipts flowchart. There are specific symbols that are used to indicate documents, display, manual processes, offline storage, etc. The advantages of a flowchart over a questionnaire or narrative is that a flowchart provides a clearer, more specific portrayal of the client's system. A possible disadvantage of flowcharts is that internal control weaknesses are not identified as prominently as in a questionnaire. The auditors should identify and assess the risk of material misstatement at both the financial statement level and the relevant assertion level for account balances, transaction classes, and disclosures. The general approach followed during risk assessment is to use all the audit evidence obtained on the client and its environment, including internal control, to identify risk, relate the identified risk to what can go wrong at the relevant assertion level, consider whether the risks are of a magnitude that could result in a material misstatement, and then consider the likelihood that the risk could result in a material misstatement. The auditor's understanding of the entity's internal control is a key input in identifying the risk of material misstatement. For example, the auditors use their understanding of the client's information system to identify risk of material misstatement that relate directly to the recording of transactions. The auditors consider the nature of the different types of transactions. There are routine transactions such as revenue, purchases, and cash receipts and disbursements. Non-routine transactions such as taking inventory and calculating depreciation expense, and estimation transactions such as determining the allowance for doubtful accounts. Generally, routine transactions have the strongest controls. Risk at the financial statement level are those that relate to the overall financial statements and potentially affect many individual assertions. The following risks are examples of those at the financial statement level: preparing the financial statements, including the development of significant accounting estimates and the preparation of the notes, selecting and applying significant accounting policies, IT general controls, and the control environment. Risks such as these potentially affect many relevant assertions in that they cannot effectively be isolated. Questions about the integrity of management also may raise a variety of questions relating to the financial statements. Because of these characteristics of financial statement level risk, an overall response by the auditor is often required. This response might include assigning more experienced staff or those with specialized skills, providing more supervision, and emphasizing the need to maintain professional skepticism. Incorporating additional elements of unpredictability in the selection of further audit procedures to be performed, increasing the overall scope of audit procedures, including their nature, timing, or extent. Some risk of material misstatement relate to one or a few relevant assertions. For example, risk associated with the failure to recognize an impairment loss on a long-lived asset affect only the valuation assertion and related impairment loss associated with that asset. Risks related to inaccurate counting of inventory at year-end affect the valuation of inventory and the accuracy of cost of goods sold. At this point in the process, the auditors make decisions about the appropriate combination of testive controls and substantive procedures. For example, when a client uses a sophisticated information technology system, the auditors may conclude that substantive procedures cannot, in and of themselves, provide sufficient audit evidence. When this is the case, there may be no other option than relying upon a combination of testive controls and substantive procedures. The auditors perform testive controls to obtain evidence about the operating effectiveness of controls. The approach is to first identify the controls likely to prevent or detect material misstatements, and 2, perform testive controls to determine whether they are operating effectively. Tests of controls address the following: how controls were applied, the consistency with which controls were applied, by whom and by what means were the controls applied. The audit procedures used to test the effectiveness of internal controls include inquiries of appropriate client personnel, inspection of documents and reports, observation of the application of controls, reperformance of the controls. The results of the test of controls are used to determine the nature, timing, and extent of substantive procedures. Auditors have traditionally used samples of transactions to test various controls. However, data analytics may be applied as a supplement or alternative to certain sampling tests. While a number of approaches are possible, 2 possible alternatives are: 1, test a number of controls simultaneously electronically through a sample of transactions, and follow up with an audit of the entire population of transactions for any controls whose operating effectiveness is in question, or 2, simultaneously test a number of controls over all transactions in a particular population. Either approach may result in the identification of possible needed adjustments to the financial statements, as well as providing more specific evidence to determine modifications of planned substantive procedures. This diagram illustrates the auditor's consideration of internal controls. After obtaining an understanding of the client, the auditor documents the understanding and makes an assessment of the risk of material misstatement. Based on the risk assessment, the auditor designs further audit procedures, including substantive procedures, or a combination of testive controls and substantive procedures. If the auditors do not believe that the internal controls are operating effectively, then they would not test the controls and would perform the planned substantive procedures. If the auditors believe that the controls are operating effectively, then the auditor performs testive controls and evaluates the results. After the test of controls and evaluation, the auditor will either modify planned substantive procedures or perform the ones originally planned. Much of the work performed by internal auditors is similar in nature to that performed by external auditors. This raises the question of how the work of internal auditors may be used by the external auditors. Statement on Auditing Standards number 128, using the work of internal auditors, indicates that the external or independent auditors may use the work of the internal auditor in 2 ways: either obtaining audit evidence by using internal auditors' work performed as part of their normal responsibilities, and are using internal auditors to perform direct assistance on the external audit. The auditors must determine if the internal auditor's work is relevant and if it would be efficient to use it, and they should assess the competence and objectivity of the internal audit function. If the internal auditors decide to use the work of the internal auditors, they should communicate how the work will be used to those charged with governance. Service organizations provide processing services to companies that decide to outsource a portion of their processing. For example, a CPA client may outsource data processing services or outsource its payroll function to a service organization. Auditors are required to obtain an understanding of how the entity uses the services of the service organization, including the nature and significance of the services and the effect on internal control. If the auditors are unable to obtain a sufficient understanding from the user entity, they should obtain that understanding through performing one or more of the following procedures. Contact the service organization to obtain specific information. Visit or engage another auditor to visit the service organization and perform necessary procedures about the relevant controls at the service organization, or obtain and consider the report of a service auditor on the service organization's controls. The service auditor provides an examination of the service organization's controls, and the user auditor uses that report. There are two types of service auditor reports provided for in the auditing standards. The first type is a report on a management's description of a service organization's system and the suitability of the design of controls. The second type is a report on a management's description of a service organization's system and the suitability of the design and operating effectiveness of controls through the period covered by the service auditor's report. When the user auditor's risk assessment includes an expectation that controls at the service organization operate effectively, the user auditor should obtain a Type 2 report, if available, or perform appropriate tests of controls. Auditors provide assurance to both management and the audit committee by communicating internal control deficiencies and material weaknesses that have been identified during the audit process, often along with recommendations for corrective action. This chart illustrates the relationship among internal control deficiencies. A material weakness is a deficiency in internal control over financial reporting, such that there is a reasonable possibility that a material misstatement of the company's financial statements will not be prevented or detected on a timely basis. A significant deficiency is a deficiency in internal control over financial reporting, or a combination of deficiencies that is less severe than a material weakness, yet important enough to merit attention by those responsible for oversight of the company's financial reporting. Both material weaknesses and significant deficiencies should be reported in writing in a management letter. A less than significant deficiency does not have to be, but can be reported either orally or in writing to management. The Sarbanes-Oxley Act of 2002 requires public or issuer companies to provide reports on internal control by both management and sometimes the auditors. Section 404A requires that each annual report filed with the SEC include a report in which management 1. Acknowledges its responsibility for establishing and maintaining adequate internal control over financial reporting, and 2. Provides an assessment of internal control effectiveness as of the end of the most recent fiscal year, called the as of date. To have an adequate basis to issue this report, management must evaluate the effectiveness of internal control using suitable control criteria and support the evaluation with sufficient evidence. Section 404B of the Act requires the company's auditors to attest to, report on, internal control over financial reporting. As implemented, Section 404B applies to public companies with a market capitalization of $75 million or more to have an integrated audit including internal control that includes planning the engagement, using a top-down approach to identify controls to test, testing and evaluating design and operating effectiveness of internal control, and forming an opinion on the effectiveness of internal control over financial reporting. In very small concerns with only 1 or 2 office employees, there is little or no opportunity for division of duties and responsibilities. Consequently, internal control tends to be weak, if not completely absent, unless the owner or manager recognizes its importance and participates in key activities. The auditor can make a valuable contribution to small client companies by encouraging the installation of such controls as are practicable in the circumstances. The specific practices listed on this slide are almost always capable of use in even the smallest of businesses. Adherence to these basic control practices significantly reduces the risk of material error or fraud going undetected. And this is the end of the presentation for Chapter 7.